You too. What's going on? Hey man, thought I'd make this video real quick, man, showing y'all how to invest your money. You know, uh, I bump into a lot of guys, you know, in trucking, outside of trucking. Um, I have brothers and sisters. I got cousins and nephews and stuff. And after talking to all these people over the last, I don't know, 15 years since I was 18 when I started my first job, you know, I've come to conclusion that a lot of people out here are just not prepared to, um, people are just not prepared for retirement. Now, when you say retirement, retirement comes in all shapes and forms. It don't mean that you're just gonna stop working and go fishing every day. To me, retirement basically means that I'm pretty much an old man and I'm able to save while I'm in my working years as a young man, and when I'm an old man, I don't have to be dependent on outside sources for income. That's what retirement means. I don't have to have a job. I'm not desperate for. I'm not financially desperate, and my whole goal is to be financially secure when I retire. So a lot of guys or just people in general I bump into, they I'm just gonna put it out there, they do stupid things with money. Now, I have done some stupid things with money too, so calling I'm not putting any names out there, but the point is like we have to take control and take responsibility for our lives. I would hate to see many of you guys work for 20, 30, 40 years for a company or in a business and not have nothing to show for it. And the easiest thing we can do is to save a little bit of money, anywhere from 10 to 15% of our income into some type of retirement program. Either you buy rental properties, or you can buy mutual funds, or you invest in your mama's or your daddy's business or your cousin's business or whatever. You got to invest in things. You got to put your money in things that go up in value or don't depreciate, so to speak. I mean, I bump into people, they spend thousands of dollars every month on things that don't do nothing for them financially. We always doing shit that feels good. Oh, it feels good. Oh, I work hard for it, so I deserve it. Hell, if the the thing is like, okay, if you deserve it, why can't you pay cash for it? Right? Why can't you pay cash for it? Because if something costs $30,000 and you don't have the cash to buy it, you don't deserve it. A calculator is like people act like I bump into people and I go to talking to them and like they act like they don't they forget how to use a calculator. We it's like since we was in elementary school, what the what second third grade, we learned how to use a calculator, right? One plus one is two. But when we become an adult, 18, 20, 30, 40 years old, I bump into grown ass people, 30, 40, 50 years old, that don't know how to use a calculator. They will go down to a dealership and buy a $40,000 car that the, that when they finish paying for that car, it ain't worth shit. You hear what I'm saying? It's like a lot of people don't get. how damaging a $40,000 car is to their money. They get up every day, every morning. They go slave to this company, and then they invest $900 a month into a damn depreciating asset in the driveway. They buy a car for 40,000. The damn car ain't gonna be worth 10. The car ain't gonna be worth half of what you paid for it when you're done paying for it. Now, the only exception that I have when we're talking about spending money on depreciating asset is that if we're using it to make money, then I'll make an exception. Okay, like if I'm gonna go buy a reefer trailer and the reefer trailer is 40,000, and the reefer trailer depreciates half of what I paid for it in about 3-4 years. You know, after 3-4 years, that reefer trailer is only worth 20. I don't mind because I'm making money with the trailer. The trailer needs to make more money above the depreciation. And like people, it's like I bump into people, they forget that. It's like I bump into people, and like if they knew how damaging it is every month to be sending that car dealership, that bank, thousands of dollars every month for a depreciating asset, why don't you go buy a duplex? You can go buy a duplex for 100,000, and the note on a duplex would be. I mean, I live in Atlanta, Georgia. I've seen duplexes for about 40,000. Now, it's not in the best neighborhoods, but I'm not living there. It's an investment, just like a mutual fund. I spent $40,000 on the investment. Okay, I spent $40,000 on the investment. If I turn around a year later, or let's say 5 years later, if I want to sell that duplex, I can probably get my money out. And on top of that, I've made money with it in the last 4 or 5 years. So it's just like, but with a car, you can't do that. You go and buy a car for about 40,000. You couldn't give away the car for what you paid for it. You're gonna be upside down on it, and plus you're paying interest on top of it. I bump into people; they're paying 15% interest rate on a fucking car. You gotta excuse my French, but I get real passionate because it's like people forget how to use a calculator. Like a calculator is so easy to use, and it's just like if you calculate it, okay, 40,000. If somebody told you, hey man, if you give me 40,000, 4 years later, I'm gonna give you back 20. You wouldn't do that deal. You're trading it's like you giving somebody $1, and then you're expecting half of your money in return. Why? Who does that? But we do it every day. We go and buy clothes. We spend thousands of dollars on clothes. Discretionary items, clothes, toilet paper, shoes, T-shirts. Like if you buy a shirt for $60, you couldn't put that shirt on eBay or Craigslist and get $60 for it. You might get 20. But we do this shit every day. We spend thousands and thousands of dollars on depreciating assets and then wonder why we're broke when we're 60. We need to continue to spend money on things that build wealth, that put money in our pocket. Those are things like trucks. We can spend money on trucks because those trucks make money, okay? Trailers, reefer trailers make money. Real estate. Real estate can be a depreciating asset depending on how you look at it. Now, if you buy a house for 100,000 and you live in it, okay, you're not renting it out. Well, that asset is now depreciating because it's taking money out of your pocket because you got to pay maintenance on the house. You got to cut the grass. You got to repair the roof. These things that are taking money out of your pocket. Now, on the flip side, you can rent that house out and make money with it. It's, a house that's bringing $1,000 in rent, that's $12,000 a month for one house. One house, if you rent it out. And if you got a job that's making 50, plus the $12,000 that you got coming in from the rental, you're sitting on $62,000 in income. You buy another rental, and the same thing applies to investing. I'm getting off tangent. I get real passionate about this stuff because it really aggravates me. It's like I see people do it all the time. But anyway, so I thought I'd make this video real quick, man, on looking at mutual funds. Okay, I thought I'd make this quick video about looking at mutual funds, and now don't worry about this account. This is a bogus account, so you know this isn't my main account, but this is just a bogus account. So any of you trolls out there think you're just gonna, find my information. No, I'm not that stupid. So yeah, so let's take a look at some mutual funds, all right, and give you guys some ideas on how to look at mutual funds and what I do when we start looking at mutual funds. When we're looking at mutual funds, what I like to do, if any of you guys follow Dave Ramsey, he talks about this stuff. Dave Ramsey don't really go into like detail on looking at mutual funds. He gives like a basic overview on what you should look at. But in this video right here, I'm going to talk about some detailed options you guys can have when you're looking at a mutual fund. Okay. Out here in the market, there is about, I say, 9,000 mutual funds available that you can buy. So when you're looking at a mutual fund, I like to tell people you want to look at a mutual fund that's got at least a 10-year track record on it. Now, I don't want to sound like I'm looking at Dave Ramsey and I'm kind of like making videos of Dave Ramsey, but you got to understand the reasons why that you look at stuff. Okay, you got to understand the reasons why. So Dave Ramsey says, okay, look at mutual funds that's got a 10-year track record. Well, why? Well, the reasons why is because you want as much information as possible to make a educated guess on buying an investment product. This is what you're doing. You're buying an investment product. So you need to gather as much information that you can to make an educated move on investing, just like looking at a rental property. Okay, if you're looking at a rental property, okay, you don't just randomly roll the dice and just drop $50,000 on a rental property. No, you do research on the neighborhood. You get the zip code. You look at how much the tax is going to be. You look at the gross rents in the area. You look at what's the turnover. You want to look at how many people own houses versus how many people that rent in a certain area. You want to look at the cap rate. You want to look at all this information before you make a decision and you start to invest in a certain area, demographic. You want to know what the income is. What's the income? How many people how many college graduates that live in a certain area? How many people that how many PhD holders that live in this area? There's a lot of information out here, demographic information. What's the crime rate? Okay, how much insurance costs? And the same thing applies when you're looking at a mutual fund. All right, so I don't use Fidelity. I just created a bogus Fidelity account just to show you guys what's going on. But give me a second here. Let me see. Buy a mutual fund. Okay. You gotta go in here. Let's see. Mutual funds. Let's see. All right. I want to look at the mutual funds. Give me a second, guys. I want to go in here and look at Trying to find the mutual funds here. Okay. So I know a lot of you guys have no idea on how to screen mutual funds, how to screen stocks and bonds. Now, I bump into guys, they be like, yeah, man, I wanna get into investing, man. I wanna trade some stocks. But okay, I don't. If you are a passive investor, someone who's not a full time investor, like there's some people out here they do very well at day trading. Day trading is basically, you trade one stock and you wait for it to go up and then you sell it. Okay, that's not what I'm talking about. I'm talking about the average person who works a 9 to 5 Monday through Friday, and you have anywhere from $500 to $1,000 in your budget to invest. Okay, and you don't want to put a bunch of money into a mutual fund, but you basically a passive investor. You want to buy the mutual fund and just put it away for a rainy day, and you want to see your dollars, your $1,000 turn into 10,000. You want your 10,000 to turn into 50,000. So this is what I'm talking about as far as mutual funds. That mutual funds are long-term investment, 5, 10, 15, 20-year investment, not day trading. I'm not getting into day trading. I really don't know how to how to do day trading. I don't know anything about that. So typically, when you come onto a uh, investment uh, website, they're gonna have all these tabs and stuff, and you pretty much want to go over to research and look for something like mutual funds. And like mutual funds are to me like the best investment tool because you can come on and invest, a couple dollars, whatever you can spare, $100, $50 to get your feet wet and learn how to invest. All right. So let's look at some mutual funds. I'm gonna click all of these so we can look at all the funds. so they got so they got 3,700 mutual funds available. Okay, they got no transaction fee funds, and you got um you got the different funds, no transaction fee. Basically, the no transaction fee funds, they're basically I don't like it. It just depends how you look at it. Okay, so you got the no transaction fee funds. Basically, these funds are free. So like, but a lot of times when these funds are free, these types of funds they would have their maintenance fees will be higher. So like if you just want to buy it one time and then move on, then um depending on what kind of investor you are, a no transaction fee it could benefit you, or depending on how you look at it. But all right, I'm gonna look at let's see, allocation, commodities, money market, municipal bonds. I'm gonna look at all of them, and let's see, we can do by class or do by risk, and let's just look at them all. All right. So like I was saying, I like to look at mutual funds that's got at least 10 years on it. If this mutual fund just opened up a year ago, I don't want to look at it. If the mutual fund just opened up 3 years ago, I don't want to look at it. 5 years, maybe, if the performance is high. Now, if see right here where it says 5 year and 10 year, this is what you want to look at. You want to focus on that because you want to make sure if you put your money into this mutual fund, it's going to stick around. Okay, you want to make sure it's going to stick around. Now, there's no guarantee. We're investing. It's risky. But to lower your risk, you want to get as much information as possible. All right. So 5 years, I'll take a look at it. If it's got like 25, 30% return, I'll take a look at it. But what we want to look at, we want to look at a 10-year. I want to look at all the funds that's got a 10-year return. And usually I go with the one that's got a high rate of return. So look at this one. This one is 15%. Okay. And it's got a 0.75% net of return. The expense ratio is 0.75. Generally, the expense ratio, I like to keep it below 1%. Anything above 1% is a little high for me. I like to keep it around 0.5, 0.6, anywhere from 0.5 at the highest, maybe 0.80%. Anything more than that is just it costs a lot of money to because these mutual funds have a maintenance fee to them. So if you got $5,000 in a maintenance in a mutual fund, and it costs you $500 a year to maintain it, that's getting a little expensive. To me, expensive is probably about $1,000, $1,100 a year to maintain a mutual fund. That's when you start to get into $1,000 a year, you eating into your profit. Your gross your interest that you're making, your compound interest that you're making. So I like to keep my expense ratio below 1%. I don't want to get into too much of that, but yeah. So it looks like the top performing mutual funds are in the health sector. So you got health, technology, IT. I don't recommend messing around with the health sectors, technology sectors. I mean, as you can see, like the health and technology is booming right now. It's performing very well, but those are risky sectors. They're volatile. So the health and the technology sectors, they go up and down. They got a heavy swing. So I don't like messing with them. When you're talking about your retirement, you want stuff that's like steady over the last 10, 15, 20 years. You want mutual funds that's steady. You want funds that are in like, if you have like, $100,000 and you want to put about $20,000 in some health or technology sectors, go ahead and do that. But in the beginning, I don't recommend messing with the health sectors because those are aggressive, high performing mutual funds. So I don't recommend those as a beginning investor. Okay, so but as a beginning investor, I recommend getting into like here's this one right here, large growth, natural resources. That's a good one. Like natural resources, that's pretty much like energy, the energy sector. Gas, natural gas, water. Water companies. This particular mutual fund, they probably invest heavily in a lot of natural companies. Let's see here. I don't want to make this video too long. I know I'm gonna make it long, but investing is a lot of work. Okay, you got to take time out and do your research and find. I'm just trying to find a mutual fund so I can go further and talk about it. Let me see. Health. You got small blend. All right, let me go back. All right. I'm gonna look at this large growth. Okay, see this large growth here it's got let's see a 10-year large growth. Okay, the 10-year rate of return on this mutual fund is 12.58%. Is It's kind of expensive. It's 0.95%. You're gonna be paying 0.95% for maintenance on this account. So it's getting up there. It's a little expensive, but it's for the sake of this conversation, we're just trying to teach. Okay. On a 5 year, it's 19.8. I think this is 3 year. That's 14.5. Um, so yeah, so it's a large growth fund, and let's take a look at it. All right, let's take a look at it. Okay. So when you're looking at a mutual fund, all right, you want to pay attention to all this information. All this information in here is very important. Don't uh don't negate none of this information. All this information is good information. Okay. The overall rating on this is a 5-star mutual fund. Okay. The returns on it is high. The expenses, the expense on this account is average. Like I say, you want to stay below 1%, 0.99%. It's 0.95%. It's getting a little expensive, but it's for this video, it's okay. All right. The risk of this mutual fund is medium risk, so it's about average risk. I like to stay somewhere down here, low risk mutual funds, high return on investment mutual funds to with a low risk, but it's you got to take it with a grain of salt, because it's like, okay, you got a mutual fund that's performing high, but it's got a low risk. Those are far in between, but if you can find one, I would look into it and see what you can do. Okay, so the year to date, um, since the inception. Let's see. I want to see what the inception date of this mutual fund. Okay, the inception date of this mutual fund began back in 2005. So we got 15. So we got 10, 15. So we got about 12 years of this mutual fund, which is good. I rather have more. I like to look at mutual funds that was opened up back in the 50s, 60s, 70s, 80s. You know, this mutual fund has been through a whole lot of market uh, swings. This mutual fund is seen from the 1950s all the way to 2017. I got a few mutual funds that are like that. I got a few mutual funds. I got one mutual fund that was began back in 1950, and it's returning about 11, 12%. So it's a dinosaur of a mutual fund. It ain't going nowhere. Um, but for the sake of this video, when you look at the date of inception, I like to look at very old, slow, boring mutual funds. That's what I like to look for. So, but this is fine. It's been around for 12 years. So since inception, this mutual fund has been making about 11.6% on your money. So it's all right. So then you got a graph here. It's compared to the S&P 500 and the S&P 500. This mutual fund is pretty much, it's been performing right along the S&P 500. So if you look at that, so you can see, okay, this is a large growth fund. You need 2,500 minimum to invest. I mean, there's some mutual funds you only need $1. Some mutual funds you need 500. I've seen some mutual funds you need 10,000, 20,000 to invest. But for the sake of this video, you need about 2,500 to invest. Okay. The portfolio of assets. Okay, they're looking at what this is probably about four I don't know, 4 million in assets, for somewhere in there. And then the classes. Okay. So compared to other assets, so what I like to look for when I look at a mutual fund, I like to look at the expense ratio. I want to know how much the mutual fund is costing me, and I want to know the rate of return, and I want to know what the mutual fund, what stocks are inside the mutual fund. And you can see here the top stocks in this mutual fund is is earning 11.98%. So these are everyday companies in this mutual fund. You got Qualcomm, you got McKinsey and Corp, um, you got UPS, uh, you got American Express. This is a wide. This is a well diversified fund because they got a trucking company in here. They got let's see, the bulk of this mutual fund is healthcare. So this is basically a healthcare fund. So you got technology. You got 34% in technology, 28%. Yeah, 28% in technology, 34% in healthcare, 16% in financial services, 9% industrials. That's probably the UPS that you're looking at. UPS is a dinosaur of a company. It ain't going nowhere. UPS ain't going nowhere. Last time I checked, UPS ain't going nowhere. So UPS is a good stock to invest in. Uh, uh, consumer consumers, basic materials is energy, real estate. Okay, so the bulk of this mutual fund is healthcare, technology, financial services. I don't know. This is a risky mutual fund to me. I don't think I like how it's performing, but I don't like what they're investing in. They got 34% in healthcare right now with Donald Trump and the healthcare bill. I don't know. That it's a slippery slope. I don't think I would invest in a mutual fund with a lot of healthcare in it. Technology is aggressive. Uh, uh, Technology is an aggressive uh, sector. So I don't think I would invest in a mutual fund that's got a lot of shares in technology. Financial services, that's risky. That's too risky for me. I would invest in like industrial type stuff. I would invest in real estate, utilities like oil, gas, um, electricity, that kind of stuff. I would do a flip side on this mutual fund. Communication services, uh, materials, uh, I would do a flip on this, but for the sake of this video, we're just talking. All right. So this mutual fund, so they invest 95% in the United States. So most, so none of these stocks, most of the stocks in this mutual fund is domestic. So it's mostly domestic. Okay. So you got a lot of tech in this mutual fund, a lot of tech. Let's see, we got Qualcomm, you got VF Corp, you got industrial company here, UPS, you got American Express Financial. So that's what's in this. So would I invest into this mutual fund? No, I don't think I would. But you got to learn how to look at mutual funds because a lot of people they invest in 401ks at their jobs or they invest into a pension plan, but they have no idea what's in it. And that's why I like, because I'm a control freak. I'm not going to tell you, I'm not going to lie and say I'm not a control freak, but I am a control freak. So, being that I am a control freak, I like to have control of my investments. I like real estate. It's a great investment because I can drive by it, I can go and touch on it, I can fix it. I can, real estate is. I like investing in real estate because it's a tangible asset. I can touch it. Okay. With stocks, I don't invest as much heavily as I used to in stocks or mutual funds because it's volatile. It's I can't touch it. So I got a little bit of money in mutual funds, but I'd rather invest in tangible assets, trucks, trailers, and things like that. So all right, so but yeah, so okay, we're gonna look at the fees. This is a big one. Okay, we're gonna look at the fees. All right, let's look at the fees. Like I said, is see here, it says $9.50 per thousand. So if you got about $5,000 in this account, it's gonna cost you about $45 to $45 to maintain this account. Um, so you need about 2,500 to get involved in this. Um, okay, You need about 2,500. Okay. See right here, it tells you what's been going on with this fund over the last year, over the last 12 months. 36. The highest is 36 dollars and 70 cents, and I don't really pay attention too much to that because I'm not a day trader, so I don't want to. I'm not a day trader. I'm a long term investor. I'm a 10, 15, 20 year investor. Okay. Let's see here. Capital gains. Okay. 0.75 to. Okay. Okay. I want to see who's the manager of this account. That's another thing I like to look at. I like to look at um the management turnover. How many times um this account has been turned over, because it tells me, you know, how active this account is. You know, because I don't like investing in heavily active accounts, because if somebody buys into it, you know, for about a week and then they turn around and sell it, that's not something I want to invest in. I want to know, you know, um, how long the average investor holds on this account, and because I'm a buy and hold type person, I make the decision one time and then I move on. Let's see the ratings. Let's see. I mean, this is I mean, according to the thing, it's a 5-star fund, but I wouldn't invest in it because I don't like the sectors that is invested in. It's not diversified enough for me. Let's see. Let's see. We already looked at that. Okay, the fees. Okay. I'm trying to find the management. Who's the manager of this account? Usually they have the uh the portfolio manager. Uh, Depending on who you go through, you got different investment. You got Charles Schwab, you got Fidelity, you got T. Rowe Price, you got all these different um brokers out here that I can't find the manager. Let me see here. Top holdings. Okay, here's the manager. Fund manager, Jerome L. Dodson. So he's held this account since inception, since 2005, which is good. Which is good. I like that. Which is good. I like to see who's running the account. Okay. Funds previously managed. He's managed a lot of funds, so he seems experienced and he knows what he's doing. Okay. He's managed a lot of funds, so this guy this guy knows what he's doing. He went to Harvard. He's got a BA at Berkeley. Okay, cool. He's a competent person. He knows what he's doing. Okay. So I don't know. I don't know. I may if I was looking at this fund, I would write it down. I would write it down. I would at least give it a thought. I would give it a thought. It's a fairly decent fund, but I don't like the fund just because it's heavily invested in um, aggressive markets, healthcare, tech, and technology. These are heavily aggressive markets. I don't like those. I like the aggressive. I like to invest in like um, mutual funds that are slow and low risk. But yeah, I know this video is probably long, but yeah, man, I just wanted to give y'all an insight on, what I do as far as investing in mutual funds. Now, this is just I may make a part two later, but this is just a short summary on, because I've been watching YouTube and you guys got videos. There's a few guys who got videos on investing, so I wanted to make a video, my own video, to show you guys how easy it is. Very easy to invest your money, to build wealth with mutual funds. It's very easy. You just go through, you just save your money, and you invest in things that go up. You don't. It's not like I said before when I first started the video. Invest in things that go up. Don't invest in things that go down. Okay? Don't. I know it's hard, but that's just my whole deal. So, but yeah, man, this is just a quick little video, man, showing y'all, about mutual funds and how my view and my perspective on mutual funds. I'm sure there are a bunch of trolls out here that probably disagree with me or whatever, but this is how I look at it. There's more to it, but I could be on here for hours talking to y'all. So I think this video is probably about 20, 30 minutes or so. But yeah, man, I appreciate y'all watching my videos, man. I'll see y'all next time.